There is a generational shift occurring in the housing market that I'm going to reveal in this video. I'm talking about how buying a home over the next 20 years will be unlike what previous generations saw in the late 1990s. This shift means that an opportunity exists right now, but it'll soon be gone and future buyers will have to adjust. The reason that this change is coming will be very clear to you before we get to the end of the video. Right now, there's a pair of opposing market forces battling it out that we are monitoring in order to determine how affordable homes will be in 2021 and beyond. On one hand, you have historic low mortgage interest rates making the monthly payments on home loans decline, but on the other hand, you've got soaring home prices making the whole transaction more expensive. The former makes homes more affordable, while the latter has the opposite effect. So how will this completely change the home buying experience over the next 20 years? Well, I've dug up some national, state, and local statistics that will help you understand where home prices are heading, as well as where mortgage interest rates and monthly payments are heading. This is something you really need to see. It's a 20-year housing market forecast that will show you a generational change that will occur for future home buyers, and it paints a scary picture of what is certain to come. Hi, I'm Joe Manassa, author of The Business of Getting Business and the creator of Manassa.com, where I've helped tens of thousands of people buy and sell homes. I would like to help you too. If you already are a subscriber, thank you and welcome back. If you're not a subscriber, please consider becoming one now. We offer the most thorough and accurate housing market reports on YouTube, plus answers to your real estate frequently asked questions, and we provide virtual tours of some of the most beautiful homes in Tallahassee. Simply hit subscribe to get started, and the bell so that you're the most informed buyer or seller in your next real estate transaction. Let's start our market analysis by studying the relationship between home prices and monthly mortgage payments, principal and interest, over time. This graph plots the average home price in red, measured on the left vertical axis, and the corresponding average mortgage payment in blue on the right vertical axis. If there were not such thing as housing market cycles and mortgage interest rate fluctuations, we would expect the blue line to rise with inflation over time. In reality, though, both market cycles and interest rate changes are a fact of life. By plotting them together, we can see that the average homeowner in Tallahassee has paid in principal and interest for the past 30 years. If you think that homes are expensive today, then you've not been viewing the real estate market through my crystal ball. Consider this. From January 1991 through December 2020, the average home price went from $75,000 to $239,000, an annual average change of 3.94%. During that same period of time, the average monthly mortgage payment moved from $582 to $971, an annual change of only 1.72%. Home prices went up at a rate more than double the rate of home payment changes. So how does that work? Shouldn't mortgage payments rise at the same as house prices? Well, no. Since mortgage interest rates are also a variable involved, we see payments move up and down due to rate changes as well. That's why today's skyrocketing home prices are not yet delivering the highest mortgage payments on record. In fact, roughly 6 of the past 30 years have seen higher payments than what today's buyers are finding. So without even looking forward, one should understand that this is not a bad time to buy a home. But when we do look forward, we see ample evidence that home affordability is about to be blown away. This is the moment in the video where I have to warn you that what I'm about to share with you is going to make you want to reject this whole video and close your eyes to the writing on the wall. Please do yourself a favor and stick around for the next 5 minutes, and I'll give you smart, safe guidance on how to proceed. When we plot a graph of market drivers, a simple yet startling conclusion can become clear. What I want to do is look for a correlation between inflation, wages, and home prices, and then forecast the next 20 years of home prices based upon what we know at this time. This graph uses national statistics and figures, so we're not limiting this forecast to Tallahassee. We see that the Consumer Price Index, our measurement for inflation, is plotted in blue, while the Home Price Index is plotted in red. The resulting dashed lines show the trend of each measurement, and you can see that home prices and inflation seem to be pretty much parallel for the past 30 years. The yellow dotted line represents where we are right now. Based upon a recent vote by Floridians, we know that Florida's minimum wage is about to explode 75% higher starting this year. See how the gray area of the graph changes at a rate not seen in the past 30 years? The change in wages will have an impact on every cost item in the construction of new homes, with the likely exception of land and development. We have to remember that the creation of the bricks, the processing of the lumber into the products that creates a home, and all the shipment of all those materials will be getting more expensive as these wage increases take effect. So too will be the on-site wages paid to assemble the homes. Now let's seriously assess the change in the slope for wage growth. This is not merely a bump in wages. This is rewriting the book on what it will cost to build a home. This is not rhetoric, and I'm not addressing whether or not this is a good thing or a bad thing. I am showing you the general slope of wages will go from nearly tracking inflation and home prices to surpassing their past pace. So you have to know that inflation and home prices in the long run are going to move higher faster. This is not rocket science. This is the reality that political changes bring to the private sector. So let's understand at this point in the video that new home prices will begin to rise at a faster rate than what has been observed in the past. Additionally, though not covered in this video, we know that the appreciation of existing homes is skyrocketing due to low inventory right now. Over the past 10 years, the U.S. has grown, but the construction of new homes has declined, creating a void in the supply of homes for sale. This has caused home values to skyrocket as there are far more buyers than sellers out in the market. The evidence paints a clear picture. Both new and existing homes will get more expensive, and they will be doing so at a faster rate than what we've seen in the past. Now, let's shift and examine another huge component of the homeownership equation. We know that the majority of home purchases are financed, so mortgage interest rates need to be evaluated as well. The average mortgage interest rate over the past 50 years is just under 8%, down to well under 3% today, and as high as 18.5% in 1981. In fact, were it not for the low rates of the past 10 years, the long-term average mortgage interest rate would be closer to 9%. You really need to let that sink in. It is fair to say that the average mortgage rate that adult Americans consider to be normal is 9%, and that is why today's sub-3% rates are a game changer. While I would love to see low mortgage interest rates last forever, that wishful thinking could lead me to great disappointment sometime in the next few years. Based upon hundreds of years of history, we know that the question of mortgage interest rates rising starts with when, not if. You just have to know these historic low rates are not the new normal. Perhaps we'll see them continue for another 3 months, a year, 3 years, who knows? But the economy will recover, inflation fears will return, the Fed will raise the federal funds rate, and mortgage interest rates will rise. So let's take a look at that first graph again, but this time with a look to the future using a conservative estimate of increased prices and increased mortgage interest rates. While my time estimates are purely speculative, history tells us this will happen at some point relatively soon. This graph shows a forecast for future home prices in red and monthly mortgage payments buyers will get when buying these homes in blue. If you live with the hopes that the government will step in and keep mortgage interest rates low for the next 20 years, then you can just follow the blue dashed line. It plots fantasy future rates at a consistent 3.5% average. Of course, there will be cycles that come, and we won't see the perfectly straight lines that this graph produces. But from my experience, we will get to where it's going. And I believe this is a conservative estimate of this future. Look at the solid blue line in the graph. Falling interest rates have kept mortgage payments over the past 10 years at or lower than what people were paying in the 1990s. Do we really think this can last forever? Look at home affordability today at the yellow dash line and recognize why now is the best time to buy a home that you'll likely encounter ever again. Historic low mortgage interest rates coupled with the relatively low price of homes gives today's buyer an advantage. Even if you believe a market crash is in the future, near or far, do you really think we'll see interest rates drop below 2.5% to counter it? We didn't see that happen following the 2006 collapse. So how did we produce our projections? Let's start with home prices. They are plotted in red. Last year, we saw home prices rise nearly 10%, and this year is poised to see an even greater increase due to an even lower supply and heightened demand due to these low mortgage interest rates. For my home price estimate, I plotted a growth of 10% for each of the next 3 years, followed by 5% growth for the following 3 years, followed by an annual growth rate of 3.6% thereafter. As a side note, if you're watching this video in the year 2040, I'll bet you're seeing higher average home prices than this conservative forecast projects. So that's how we came up with our home price projections. Let's look at what we did for mortgage interest rates. Again, being conservative, I forecast mortgage interest rates to decline in 2021 and then rise only slightly in 2022 as the U.S. works to restore the economy that was weakened during the COVID-19 pandemic. Then, over the next 10 years, I plotted mortgage interest rates moving slowly up to 9%, the average rate from 71 through 2010. So, how do I know this is accurate? I want to be crystal clear on this. Nobody, and I mean nobody, knows what the long-term outlook is for mortgage interest rates. But there's a theory used in finance called reversion to the mean that suggests that asset price volatility and historical returns eventually will revert to the long-run mean or average level of the entire data set. Simply put, reversion to the mean suggests that over time, things always go back to normal. And normal for mortgage interest rates is 9%, so applying reversion to the mean makes me expect rates to move back to normal over the next 15 to 20 years. Now, if you believe the interest rate cycle is broken forever and mortgage interest rates will remain low, I've produced the blue dashed line that shows what monthly mortgage payments will do with a fixed rate of 3.5% starting a few years from now after the recovery period. Again, I believe this is conservative, as a reversion to the mean would have mortgage interest rates rising above 9% to help restore the long-term average back to 9%. If you take this graph as a conservative or realistic, then you need to know that the $240,000 purchase of a home resulting in a $971 per month mortgage payment today is going to be a $600,000 home purchase with a $4,500 payment in the year 2040. Remember, this is a conservative estimate. For example, say you're in your mid-30s today and you have the 1.5 children like your peers. You likely live in this $250,000 home. 10 years from now, you'll have produced good equity, as it will be worth more than $425,000. But will you be able to move? The next move-up home for you and your family will cost roughly $700,000, and you'll need to triple your mortgage payment due to the increase in both the amount borrowed as well as the higher mortgage interest rates. And that brings us to a point you might not have considered. Unlike the last generation of homebuyers, who every time they wanted to move to a larger home were able to do so with lower mortgage interest rates, today's move-up generation will be stonewalled each cycle by rising mortgage interest rates and significantly higher costs. Think about it. The experience of moving to a larger home will not be the norm. Rather, it will be a hard-fought victory for those who are able to do so in the future. My advice today is simple. Whether moving up or moving down, do it today so that you can lock into these crazy low, history-changing mortgage interest rates. The future you will love you for it. If you would like to see more videos about our top tips for home buyers, I have assembled a great playlist that you can view by clicking on the box on the top left corner of your screen. For a playlist of top tips for home sellers, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.